Well, ladies and gentlemen, welcome to the FSI CIFA workshop. My name's David Gallagher and I'm the CEO of the Centre for International Finance and Regulation. It's a pleasure to be able to host an event like this, and just at the outset I'd like to thank the Secretariat for not only their participation here today, but also for their support of our work. And today is really an opportunity to provide academic perspective and input into issues that the financial system is obviously grappling with through this the terms of reference. We're not speaking on behalf of the FSI, of course, but academia is an important conduit in any debate around policy, and our centre, which is generously funded by the federal and New South Wales state governments, is willing and able to input and to provide strong support and theory and empirical evidence in terms of the issues that make a sound financial system. Our centre is a $41 million centre, and we participate in doing research that is empirical-based research that adds to public policy debate. Also executive education. We have a number of projects that we're funding currently. We are a consortium-based centre with 6 universities, a couple of research centres and 4 industry partners. We have key financial regulatory support, and they are represented on our board and advisory council. Some of the research projects that we're currently undertaking include looking at the costs and benefits of financial regulation, which is obviously something in the focus at the moment for the inquiry, portfolio disclosure research, sovereign wealth funds and state-owned enterprises. Last month we launched a major report on the internationalisation of the renminbi. And we also have some major work that is being done with one of our research centre partners, Capital Markets CRC, evidence-based policy making on securities markets. I thought I'd just take an opportunity to just discuss some of the work that we've been doing in terms of the financial system inquiry submissions. Goodness, isn't it amazing, the internet and the availability of information. So what we've done here is we've got access to the publicly available submissions that have been made to the financial system inquiry. And what we're trying to do here is to understand quickly what's been received. Obviously there's terms of reference which the Secretariat are working within, and we're trying to understand very quickly using some funky sort of techniques such as text analytics, what's been received and what are the key issues that stakeholders have been discussing. So what we've actually identified is there's 298 submissions that have been uploaded onto the Financial System Inquiry website. That's the total number. There's only 233 unique submissions. There's a number of appendices, etc., that have been received. But most of the submissions have come from the professional industry associations, about 25%. And you can see there's a number of others. There's listed companies, there's academia, there's a number that have come from the Reserve Bank, ASIC, etc. There's also a very small number that have come from charities and church groups, etc. If you have a look at the pie chart, you can see there the different sources of submissions that have been received. Of the 233 this is, the unique number of submissions. We thought we'd have a quick look and see whether the source of submissions had changed since the last inquiry, which is the Wallace inquiry of 1997. And it's probably no surprise, although you won't be able to quickly compare, but there's no real change in terms of the source of submissions. So I guess even though there's been a couple of additions in terms of regulatory bodies since Wallace was established, we've basically seen no change in both number and also the distribution of the submissions. We also did a qualitative analysis of the key common themes that the inquiry is looking at. And again, no surprise, there's very common words. Obviously, when you have a terms of reference and you have an inquiry, then the Secretariat is going to be very narrowed into what those terms of reference actually are. But the 12 common themes that we looked at qualitatively is the banking system, challenges and opportunities came up, financial advice, financial markets, financial system integrity, funding, insurance, legislation, the payment system, regulation and policy, superannuation, and then there was a number of general references that we just had in a separate category. Next, what we did was wanted to apply some of the we'll look at the distribution again based on the key 12 themes that we saw. This is just a qualitative analysis. And tried to look at, well, what are the key words that the participants in the sector are basically trying to get across in their submissions. The interesting thing there is at the very bottom of the table. It didn't really matter which segment of the financial system we're talking about. Pretty much all of the categories were mainly concerned about superannuation and the regulatory and policy aspects in the system. That's just by a pure count and a qualitative analysis. Next thing we wanted to do was be a little bit more sophisticated. So what we've done here is, with my colleagues Kingsley and Camille at the centre, is to try to look at text analytics and to try and use word counts and other sophisticated measures to see what was actually being discussed. So this text analytics process for the financial system inquiry submissions gathers all of the information, creates word statistics, we do some clustering and we try and get the key themes, and then that leads to a last process which is a pattern analysis. If we just do a really simple word cloud, which is another technique that you can use with data, and this is just on the financial system inquiry terms of reference. Probably no surprise, you see financial as the key word that's being used in that space. The next thing we did was we used a text analytics robot, which we called Reg. I don't know how we came up with that word, but Reg is our robot. And we're trying to then understand the keywords that are being used by the different segments of the financial system and the participants in terms of the submissions that were received by the financial system inquiry. Won't go into the details of how we did it because it's still only about 9 o'clock in the morning, but what we've done here is we've tried to look at a frequency of the rank of the words that were used, and you can see here that there's about 2.5 million words that were captured by about 298 total submissions, or 233 unique submissions. But when you sort of boil it down, there's only 34,000, when I say only, 34,000 unique words. And if we ignore in the text analytics some of the keywords like full stops or ands or ors, etc., then we can get right down to about 2,000 words that account for about 80% of the total keywords. So what does that tell us? It tells us that we have a financial system which has broad support from a variety of different stakeholder groups. We can use a lot of different techniques to better understand what the key issues are. I think today we know what the key issues are, and we know what they are with the terms of reference. I'm really pleased that we have this opportunity to provide academic input today, and again I thank the Financial System Inquiry Secretariat for their support in and attendance today. So, ladies and gentlemen, it gives me great pleasure to introduce to you David Murray, who's the chair of the Financial System Inquiry. David Murray joined the Commonwealth Bank in 1966 and was appointed Chief Executive Officer in June 1992, and he retired from this position in 2005. In November 2005, the Australian government announced that Mr Murray would be chairman of the Future Fund. His statutory term ended in April 2012. Mr Murray is a member of the Oliver Wyman Senior Advisory Board and a consultant to 10X Proprietary Limited. He was formerly a senior advisor to Credit Suisse Sydney. He's also previously served as a member of the Finance Sector Advisory Council, and he was the inaugural chair of the International Forum of Sovereign Wealth Funds. In 2001, David Murray was awarded the Centenary Medal for Service to Australian Society in Banking and Corporate Governance, and in 2007, he was made an officer in the Order of Australia. Mr Murray holds a Bachelor of Business and a Master of Business Administration. He holds 2 honorary doctorates from Macquarie University and University of Technology, Sydney, and he's currently the chair of the Financial System Inquiry. Ladies and gentlemen, David Murray.
Well, thank you, David, and congratulations on the work that you're doing. I'm glad to see there's no distinction between and or in common English text, although it's cleaned me up in a couple of agreements. But the work that CIFA does is very important. It was a great innovation coming out of the Johnson Review, and I hope that it continues to contribute in Australia and particularly in Asia. It's good to have Professor Kevin Davis and Craig Dunn here today, who are my fellow committee two of my fellow committee members on the inquiry, and you can milk them for whatever you like. So 4 months on, we've received the submissions, as David has pointed out, and today is another opportunity to hear views and welcome perspectives, particularly from academia, so that we can get the best perspective on the work that we're trying to achieve in this inquiry, particularly in relation not just to the current system that we have today, but to future developments in the system. It would be a shame if we did our work with all of the intensity of scrutiny after the global financial crisis that has taught us so much, but we laid out a blueprint for the Australian financial system that didn't adequately take into account developments over the next 10 or 20 years. The submissions we've received have gone into regulation, competition and consumer outcomes, superannuation and meeting the needs of an ageing population, and banking and technology. Naturally, views on these items have been shaped by those making submissions. Just let me give you a flavour of those. On meeting funding needs in the system, big business is saying that the system operates reasonably well, except that domestic bond markets could be a more active part of the capital structure in Australia. On competition, major financial services providers are telling us that the financial system is competitive, but over-regulated and maybe uncompetitive in some sectors internationally. Smaller players are saying they're disadvantaged, asking us to level the playing field on regulation, competition and cost, especially in banking. On regulation, consumers are saying that the regulatory framework is generally sound and lending has improved, but there are concerns about disclosure and financial advice and investment, as well as financial exclusion and low-income access for some financial products. Regulators are saying the system works well or are asking for more powers. There's a lot of surprises. Technology is a key theme, and it's something that I'll come back to. Technology and people. The needs of an ageing population, in particular the ability to manage longevity risks, are key themes. As we know, the superannuation system is a very large pool, but it might need to be better aligned to the needs of its members in retirement. We're now testing these perspectives and analysing issues using a broad and deep database of empirics and ideas. So the Secretariat, who've done an amazing job getting us to where we are now, are extremely busy at the moment pulling all this work together. Our focus is to identify those aspects of the system which will limit or prevent the development of the financial system to meet our future needs. Needs shaped by an ageing population, increasing longevity risk, an economy more closely aligned with Asia, and an environment where technological advances will raise community expectations about the services provided by the sector. Australia's financial system has served us well since the Wallace inquiry, and in general it's been an awful long time, the 1890s, since depositors have lost any money in banks in Australia, but we've not been immune from some costly failures, including HIH, TRIO, although not discussed much. One can recall the problem with the automotive industry in the crisis itself. So issues can arise unexpectedly from different quarters, and we need to deal with that. But of course, a very big issue for us is the introduction of a much clearer moral hazard for the taxpayer than was evident before the crisis. So these experiences, coupled with future needs, suggest that a rebalancing is needed of some of the current financial system settings. In that regard, let me just turn to technology. In business, typically in framing a strategy, we look at competition as the starting point, in particular the relative bargaining power of buyers and suppliers in markets. And then we trawl through the combination of technology and regulation. Technology to determine what more we can do in respect of our own competitive advantage, and regulation to see who's going to wreck the party that we're trying to construct. Commonly, the issue of technology and competition is top of mind. Regulation is generally regarded as something that can be dealt with sensibly. At the moment, this is probably not the case. The response of governments after the crisis to do, as they say on the nightly television when something's gone wrong, this will never happen again. Well, of course it'll happen again. It'll just happen from a different starting point. But the regulatory response has been around the notion that it won't happen again. And so it's been a very intensive period since the crisis of regulation of the financial sector. But to the extent we can look forward, a combination of technology and demographics, as they do always, will be the main drivers of change. So just focusing on technology for a moment, in financial services, particularly in banking, this started with self-service. Whether it was through the use of credit and debit cards, ATMs and so on, the first driver of efficiency was through self-service. That has already morphed to an amazing array of self-service opportunities for bank customers through the internet. So what could only be done by a rather complex set of processes and training of people inside a bank is now done by sourcing of all sorts of products directly from the internet by customers, and it's only just started. The use of big data initially in banks was for customer relationship management systems and the development of risk management systems, asset liability management systems, which could do 64 simulations of systems overnight and fine-tune the management and pricing within banks. This is now morphed into the use of big data for social networks, behavioural profiles, and the establishment of new businesses themselves. such as Alibaba, Google, and so on. At the same time, and these new businesses typically start on one aspect of the system and then start to tack on financial services. And depending on the regulatory and other structures in particular economies, they present quite ripe opportunities for shadow systems to emerge next to the financial system if we don't think about the operation of the system well enough. And biotechnology and DNA mapping will have an effect on life insurance. Mapping capability, weather measurement systems will have significant implications for insurance. The development of new payment systems from these business models will bring the integration of large amounts of data together with payments, which will have amazing efficiency effects, but it will also bring new models and shadow systems into play. What's not thought about with technology typically, because we go to the sort of physically visible aspects of technology, is more to do with what really started, I think, a lot of change in the financial system with the Black and Scholes work and options pricing. That was the generator of so much new work. And we have securitisation, but what's next? And it's important with these developments for us to continue to ask whether some of the models are valid or not. For example, is the capital asset pricing model okay or not? Is efficient markets hypothesis all right or not? It's very important to have a academic system of integrity continually reviewing these arrangements. And if you're in doubt, remember that some young punk somewhere in the world has already challenged Einstein's theory, so we can never stand still. In respect of asset management and retirement, we rely on the theory of the social discount rate to justify intervention in people's lives. Is that satisfactory? We rely on the notion of information asymmetry to justify intervention. Is that okay or not? I remember when I first wrote a home mortgage for customers at the Commonwealth Bank back in the 1970s, one of the important issues in handling a loan application for a home mortgage was that we had some secret information that the customer did not have, and that was the list of tables produced by our actuaries which told you what the credit foncier repayment arrangements were for a 25-year loan at a given interest rate. That information's available on a $10 pocket calculator now for anybody. But financial literacy is still a serious issue. At the time we set up the Commonwealth Bank Foundation about 15 years ago, we devoted the work of that foundation to financial literacy, and Monash University helped us do a study of financial literacy that demonstrated that we could add $6 billion a year to GDP just by improving the level of financial literacy up to less than a knowledge of compound interest. That shows you how much of a gap there is for many people, and so with the issue of longevity risk, how well will people ever understand the compounding effect of fees on their retirement balances and incomes, of the notion of rebalancing in portfolio management, in which there are quite different views in academia, the benefit of diversification risk and how many assets are needed to diversify a portfolio, the notion of mean reversion, which some people agree and others don't, If you can live till you're about 200, you can get the benefit of mean reversion. And importantly, expectations, particularly in what many regard now as a low return world, so government mistakes on monetary policy and fiscal policy which helped cause the crisis and which need to be dealt with over time, the leveraging problem, themselves create a low return world for a period of time. And when expectations are high and people seek out returns without understanding the risks, then some of the behaviours after the crisis were based on an assumption that the world would immediately revert to the sort of returns and shape of returns in equities that had been the case before the crisis. So these issues about hard and soft technology in finance are absolutely critical, and we need the academic world, an academic world of integrity and curiosity, to keep working on them, and that's why CIFR's work is important. And lastly, I just want to mention that we tend to focus very, very hard on technical systems, and we tend to focus much less on human systems. In theory, a lot of work's done on agency and agency risks, but human systems are about more than that, and predominantly about culture. I want you to think about why in the lead up to the crisis you could have two large, not in Australia but elsewhere, two large systemically important financial institutions, both with the same PE, both with the same market rating, both with the same set of regulators, both complying in every respect with all of the regulation they were subject to, and when the crisis came along, one of them effectively failed and the other did not nearly fail. How can this be so? So the issue about culture, what drives people in one institution versus another, is something which needs much more scientific study and probably not something that one can regulate for, but needs a community which is prepared to discuss these issues vigorously and examine why the culture of an organisation is not studied more. Analysts don't tend to care about it. Proxy voters have managed to construct a cookie-cutter model of annual meetings that doesn't take attention, doesn't care about these things. But if the owners of financial institutions don't take more of an interest in the people who govern those financial institutions and how they interact with the management of those institutions, it gets harder for us to encourage great cultures in financial institutions. With that, David, I'd like to thank you for having me here today, and I hope what you discussed today will produce some really great areas for us to do the substantial body of work that we're still to do. We're looking forward to getting our interim report published hopefully in July, and after that another round of submissions. We can tease out that self-interest a little bit more and see what we can generate in the national interest. But we're looking forward to that, and again I'd like to pay tribute to the work of John Lonsdale and all of the people on the Secretariat, and to my fellow committee members in helping with this inquiry. Thanks for having me today.
Thanks to David Murray for that excellent introduction. to today's session and perspectives on the current inquiry. My name's Kingsley Jones. I'm a research fellow with CIFA. My role this morning is to introduce a number of speakers who will be providing perspectives, much like David did. To begin with, I'll introduce Professor Robert Officer as our first speaker. He's Professor Emeritus of the University of Melbourne. Professor Officer was at the University of Melbourne's Melbourne Business School as a Professor of Finance from 1986 to 2002. Previously, he was Professor with the Department of Accounting and Finance at Monash University. He's a past President of the Accounting Association of Australia and New Zealand, and for 8 years was Editor of Accounting and Finance, has held positions at the University of Chicago, Queensland, Rochester in the United States, Stanford Business School, and the Wharton School at the University of Pennsylvania. Professor Officer was Chairman of the Victorian Commission of Audit in 1992-93, Chairman of the National Commission of Audit in 1996. He was Chairman of the Victorian Work Cover Authority from December 1997 to February 2001, and Chairman of the Victorian Funds Management Corporation from 2002 through 2006. He was on the board of the Bank of Melbourne before its takeover by Westpac in 1998, and currently he's chair of several funds management companies, each covering different products of financial markets. Professor Officer has published research papers in Australian and overseas journals covering a number of areas, including corporate finance and taxation, share market statistics, and regulation, deregulation of business, and the entity's cost of capital. So it's with great pleasure, ladies and gentlemen, that I welcome Professor Robert Officer to the podium. Thank you.
Thank you very much. My brief today was to talk about topics that may be of interest, and of course that means may be of interest to me. They cover a number of the areas that David referred to. Any one of them could fill up the whole day. I can't pretend I've gone deeply into the research on these things, and I seem to be a lightning rod for controversy, so I dare say some of my comments will raise hackles and debate, I hope. Now, for one who has trouble chewing gum and walking, I'm not sure how I work these slides. Does anyone? There we are. Magic. I've got 4 topics. I don't think I'll get through them all, and I'll rely on someone to tell me to sit down. But I thought I'd just briefly give you an oversight into what my thinking is on some of these. The first one is the most important one, but probably the one that needs most research, and my reading has been pretty casual in it. Typically, the popular journals and the like, I haven't pretended to do deep research on it. It goes to the role of central banking, the importance of providing liquidity, and what to do in the case of insolvency in the system. My view, the best way to remove the moral hazard we're all conscious of is some form of insurance, but it is technically fairly complex, and I just direct people in that direction. How to execute may be a different issue altogether. I briefly touch on the 4 pillars policy. I think it's an unnecessary constraint on the banking system that I believe is competitive and open to international competition. Superannuation, another recent claims that the Australian super industry is not cost efficient, implies that somehow or other it's uncompetitive, and the evidence I've seen to date to support such contentions is weak, and the inferences drawn from it even weaker. Finally, the housing market and the mortgage market. To me, there's a lot of wasted emotion on housing and claims that it is overpriced and inefficient use of resources. I mean, maybe all of that, but the question is, what do you do about it? And in particular, when it's claimed that investors are the cause of the problem because of negative gearing, raises my hackles, because it's turning the clock back, of course. To ban negative gearing would be to double tax debt. We've come out of that where we double taxed equity with the introduction of a full imputation tax system. To remove negative gearing would be to go backwards, in my view, in terms of efficiency issues. We may not get a chance to talk that through in detail. Now, central banking is important. Just to remind you, of course, central banks are relatively new, although, of course, the Bank of England has a long history, but it was private until nationalised in 1946. Central banks have their critics, but no one, in my view, could credibly argue that they don't have a role in limiting or preventing bank runs and managing major bank insolvency issues to preserve the payment system and really financial stability. The most open, those economists, which I include amongst myself, who like to see as much unfettered regulation or limited regulation as possible, like to see competitive markets, would agree that there's a real role for a central bank. There's something specific about bank runs and the like, and as David mentioned, we haven't had any problems since the 1890s. Our central bank didn't commence until after that date. In fact, it predated the US Federal Reserve. An example of this is not long before I joined the Bank of Melbourne, at the time of the Pyramid Building Society collapse, and looking at the audience, there's probably a few of you can remember that. There was a run on the bank because we'd previously been a building society or amalgamation of building society credit union. It never got any publicity, simply because the Reserve Bank directed other banks to keep the money flowing into the Bank of Melbourne as depositors were taking it out the front. The money was going back through the back door, and it ran for about 3 or 4 days, settled down, slowly depositors returned, and it was all over. Never got any public. That's a good part of a central bank. You need a ringmaster, if you like, making sure you get through such events. Of course, the global financial crisis has reinforced the importance of central banks. They're critical in the provision of liquidity to financial systems, particularly the banks. A central bank such as the Reserve Bank provides liquidity during a crisis by buying some of the bank's assets to provide the bank or banks with cash to meet the demands of depositors or other holders of the bank's liabilities. A critical issue is what price should a central bank pay for such assets? It is not such a big call when the central bank purchases government-issued securities, because the bank's ability to control or at least have a significant effect on nominal interest rates. It is a much bigger call, as occurred during the GFC, when central banks extend their purchases beyond government-issued securities to privately issued securities such as mortgage-backed securities and the like, which have significant credit risk attached to them. It's a judgment call, but the central bank should price the securities at a price they believe they can get out of them at a later date. In this context, it's very much a commercial decision. In fact, a lot of this, I think, we tend to think of the RBA and other central banks as a monolith there that is governed by regulation. A lot of their activities really belong in the commercial domain, and as witnessed by the fact that we didn't have central banks for a long time. It's really only in the 20th century they developed. Economies can get by without them, but their presence gives stability. If a central bank such as the RBA, I'm going to have trouble keeping up because my notes don't correspond to the overheads. If a bank such as the RBA is forced to discount the assets to a significant degree, the bank may be forced into insolvency. Simply there's no equity left, which is not hard with a bank and the gearing it entails. The discount could lead assets to fall, extinguishes the equity. If the RBA or other central banks buy at a price that it cannot offload those securities at a later date, not only will they lose money on the transaction, they encourage the banks to adopt risky behaviour, the so-called moral hazard problem. in effect encouraging banks to incorrectly pricing risk, knowing that a central bank will bail them out. It's the too big to fail issue. And that's an interesting concept too. What is failure with a bank? From my perspective, it's a failure when the payment system breaks down, the threat of contagion. It may not be simply insolvency in the strict word that there's no equity left in the bank. Clearly, the quality of the assets of the bank is critical as to whether the central bank has to handle a simple liquidity problem or whether it's facing an insolvency issue. It should be apparent that the provision of liquidity and to the extent it's a simple problem can move on to a much more complex issue of solvency. They are different points in a continuum, from short-term liquidity problem to insolvency. Moreover, it may not be clear, certainly through crises like the GFC, where the central bank has to intervene, whether it's facing a simple liquidity issue or whether it's ultimately going to face an insolvency issue. Now, of course, banks are not the only enterprises that face this, and it may not necessarily be poor quality of assets. A good example of this, I think, was Centro Properties, which is now called Federation Centres. The assets were good, the funding or the financing them was poor. But why should banks get special and apparently favoured treatment in these circumstances? It's because banks are critical to intermediation, the payment system, as I've mentioned, and transactions in the economy. A problem with the banking system can embroil the whole economy. However, the economy cannot be held to ransom by the banking system. Its apparently favoured treatment needs to come at a cost to the banks. And it's not just the rest of the economy. Otherwise, we have the moral hazard problem I referred to. Conceptually, the cost to the banks, or the central bank's provision of lender of last resort facility should resemble some form of insurance premium. The attempt to address this issue to date has been given under the Financial Claims Scheme, a guarantor of depositors below 250k. That's too little, of course, and it really, and they're charging some fee for it. It's a limited form of depositor insurance. It may prevent a bank run. It does not protect the bank from poor quality assets and ultimately insolvency. So there's a more general charge for insurance against insolvency required in order to overcome the moral hazard problem. To overcome this, in my view, you need a broader scheme of insurance. The alternative, what we've got, of course, is we get prudential regulation. And the problem with prudential regulation is, where do you stop? At what stage do the bureaucrats become the runners of banks? And at what stage do you leave the banks have their freedom? My view is you give the banks as much freedom as possible, and the easiest way to do that, I think, is to charge them a premium for provision of liquidity and buying their assets or protecting depositors much broader than just those who have got 250,000 with the bank. The system I think I'd go along with is to reintroduce a version of the Australian Government Guarantee Scheme that was adopted during the GFC, where the bank's large depositors and wholesale funders were covered against default for a fee. It is far better to introduce such a policy, in my view, when there's no pressure on the banking system, than to do it in reaction to a crisis. Moreover, unlike the current system where there's a fixed rate on the deposit insurance, I'd like to see a variable rate. The worry people have with a variable rate is it might encourage contagion as you change the rate according to the risk of the institution. I think that's easily overcome by making it quite transparent how you're setting these rates. We see it all the time in stock markets and the rating of various agencies. I then think you run the risk of a contagion problem by having an insurance premium that reflects the risk of the banking system or the risk of the particular bank, and changes in that should be transparent and anticipatory so far as I think you could have a number of key parameters that you knew those setting the premium were using to set it. Let me move on to 4 pillars policy. This was set up as a 6 pillars policy. The intention was to limit the power of the banks by combining. Around that time there was some movement between the banks. There was also a crisis soon after. It was also to protect the major Australian banks against takeover by foreign interests. Now, there's been a lot of changes that have occurred since the introduction of that policy, and even the Wallace report recommended its termination. This is a view I subscribe to. I believe that not everyone would agree with that. In fact, I understand David Murray doesn't. They may be correct, but I think the onus is on them to prove why you should maintain that policy. It is, in my view, an unnecessary constraint on banks. You can't claim the banking system is not competitive. It's changed dramatically. When I was on the bank of the Board of Melbourne, our interest margins were something like 4.5%. They're around 2.5% today. Was banking uncompetitive then? No, it wasn't. It competed a lot on services. And of course, the mortgage originators coming in, offering just a single line of loans, cut the interest rate. The banks had no option but to follow. And of course, services suffered. We get more complaints now about the lack of service coming from our banks than we used to, simply because the nature of competition's changed. It's a dynamic system. David's mentioned the technological advances in banking, changing dramatically, and it will continue to change dramatically. This has enabled much more competitiveness amongst banks and like institutions. We're getting major retailers beginning to provide credit facilities that compete with the banks in the way they provide credit. International banking, it's very much a global issue. So it's all those issues that I think require us to re-look at this. The comment that, you know, if you had a combination of 2 of the Australian banks, it'd start exerting market power. I don't think it would, by any means. At best, you may get some economies of scale, which of course some of the smaller fringe or shadow banking would complain like hell because it's not a level playing field. Well, it was never meant to be a level playing field. If you've got economies of scale, why don't you realise them? The point I'm making here is even a combination of our 2 largest banks would still, on assets, total assets as distinct from the capitalisation of market equity, which is only a small fraction of the assets of a bank, would still rank them only at 17. Currently, our banks rank in the 40s in terms of scale. So they're not large by international standards, even though they dominate the Australian economy, unlike most of the other banks dominate other economies. I don't think the problem of overseas funding presents a particular issue if the banks were owned by, or one of the majors was owned by an overseas. The regulation, they'd still have to comply with Australian regulations, the exposure, the hedging and the like, and of course, if we had an deposit insurance scheme, they'd be paying premiums if they took on risky investments. I guess the point I'd make on this is where would the Swiss banking system finish up if it had a comparable policy system? I think it's an unnecessary constraint on our banks doing a lot more international banking and the benefit that would have for the economy. And I'd like to see it reviewed by the Financial Systems Inquiry in that context. This brings me on to super. And there's a recent article in The Age which I think captures some of the discussion around why Australians pay higher fees on their superannuation than almost any other country in the OECD. It's been estimated that paying just 1% more in fees result in retirement benefits worth 20% less over 30 years. We've seen that in many forms. The most recent, of course, is the Grattan report, which I'll talk about in a moment. They started out with the Reserve Bank's submission of the Financial System Inquiry, but all the RBA submission did was raise people's attention to the costs of Australian super scheme. They didn't draw the next arrow that there's some form of super sting. They were careful in how they handled that. Not so careful have been some of the commentaries, and particularly the Grattan report. There are many components to superannuation. And I list some of them there. One of the big differences between the Australian system and many of those overseas is ours is dominated now by defined contributions rather than defined benefits. Defined benefit schemes typically, because of the risk the trustees are under, go into much more conservative investments. Conservative investments are much cheaper to manage. I sit on a fixed interest fund, I sit on a large equity fund, and I sit on a microcap fund and also a private equity fund board. Our fees are quite different. They're all highly competitive, but the costs of doing the research is quite different. And there's a range of fees. In the paper, I've got some numbers there, but for example, in the large cap fund I chair, our median fees are around 40 basis points, but they run down to around 12 and up to about 60 or 70, depending on the nature of the mandate we've got and, of course, the size. There is economies in scale, obviously, and they are reflected in the fees. It is highly competitive. You drop the ball for a moment, you lose customers. So the point I'm making here, it's very hard with all these different factors to control for them when you're comparing different superannuation or pension fund schemes across countries. If you believe it's uncompetitive, in my view, a much more productive way of going about it is looking for barriers to entry, looking for what might stop it being competitive. And returning to the Grattan report, they blame disengagement as the reason that it's uncompetitive. Now, they have a point here in the sense that these people self-select. They're a group who aren't looking around for the best deal, and there may be a role for a central fund for them. Maybe. But I do point out, at the moment, putting aside the my super stuff, in most of the so-called disengaged finished up in balance funds. A good number of us consciously select balance funds. So I'm pointing out that even in balance funds, there are those who are engaged and will move between funds for what they think is the best balance fund for them. The mere fact that they might be dominated by the disengaged is, I would argue, missing the point. It is not the average investor or the average consumer that determines the price in the market, as anyone from Economics 101 knows. It's the marginal investor, those who are prepared to move. How big does that require? It depends on the nature of the market. So you can't just draw conclusions by broad surveys that say the typical fund guy is disengaged, therefore the industry is gouging. Secondly, my other complaint about the Grattan report is they use at a maximum 10 years of data. Now, if you look at 10 years of data, we've had over that period bond rates dropping to these minimum levels. And there's been some who have been brave enough to say all super should be in bonds. Look at the performance over the last decade. They'd reach a totally different conclusion if they looked at the funds since the Second World War and the performance. So looking at 10 years of data, anyone who's worked in this stochastic world of investment know you can't draw firm conclusions on 10 years of data. In fact, anyone who's prepared to take short periods of data, you can justify any hypothesis, no matter how ridiculous. It's a difficult issue and very hard to reach firm conclusions with such a process unless there is profound differences. As I said, I return to the point I make about the barriers to entry and looking at that. Let me finish up quickly on housing. Housing loans account for over half the total loans made by the banking system, about 40% of the bank assets. It's large, a large proportion by any. Gets considerable attention. There's a lot of emotion attached to it. Often you hear housing's unproductive. What nonsense is that? Food is unproductive in that context. There's a certain amount of housing which is a production good. It's needed. You've got to house workers. Beyond that, yes, the swimming pool may not be necessary. It's a consumption good. Food, similarly. Need a certain amount of food to be able to work. But the elaborate banquet becomes a consumption good. No different conceptually. Then the question comes, well, investors are crowding out homeowners. Well, of course, investors are putting money into housing. What do we know about first principles of supply and demand? Other things being equal, you put more money in, you'll get greater supply. So investors are very good for the renters. They might be crowding out the homeowners, but they're doing the reverse. I could argue the homeowners are crowding out the renters. You don't hear that argument because it's a partial analysis, often driven by emotion when it comes to housing. If my, again, very limited examination of this points more to a supply problem to the extent we've got a problem. The notion that somehow or other housing is overpriced may be right, but do I want a bureaucrat making the judgment on when housing's at the right level? We'll go through these periods, as David has warned us. You can't regulate out of these crises. You can limit them. You can minimise the small ones, like the Bank of Melbourne example I gave you, but you will always face them. To eliminate them, it's a bit like what's the level of theft out of a department store? There is an optimal level, otherwise you finish up frisking every customer and you drive your customers away. You've got to allow a certain amount of failure in order to get innovation. Innovation involves risk-taking. If you put too many prudential controls, you eliminate risk-taking, eliminate innovation, and the economy will suffer. Thanks very much.
Thank you to Professor Officer for that wide-ranging presentation. So next up we have Alan Cameron, who's currently a consultant with ACES but was former chairman of ASIC. He's a consultant in the corporate group in Sydney. His practice is focused on regulation and governance. Experience includes mergers and acquisitions, prospectuses, corporate governance, trust deeds, administrative law and general corporate work. Alan works principally as a company director and an advisor on corporate governance and regulatory issues. He's a chairman of several companies in the Westpac Bank Group and of the Reliance Rail Consortium. He's been the Commonwealth Ombudsman and served for 8 years as chairman of the Australian Securities and Investments Commission and its predecessor organisation. Alan's a Fellow of the Australian Institute of Company Directors and the Securities Institute of Australia. He is National Executive Partner of Ashurst from 1989 to 1991 and Managing Partner from 1982 to 1985. So, ladies and gentlemen, please welcome Alan to the stage. Thank you.
Listening to that introduction reminds me to track down all of those old CVs on the internet and kill them off. In fact, the clue was given when it referred to the Securities Institute, so those of you who know that that's not the Securities Institute any longer will know that that's an old CV. It's largely accurate, but I'm no longer chairman of the Reliance Rail Consortium, but I think in every other material respect it's all right. Now, can I say straight away that I'm not intending to make any submission with respect to this financial system inquiry, any more than I made a submission to the Senate committee reviewing the performance of ASIC. So this is the only opportunity which I intend to take to say anything about these issues. Now, that doesn't mean that I'm not interested in them or indeed concerned in them. I've remained active in this space since the 16th of November 2000. Yes, it's that long ago, when I stepped down as chairman of ASIC. I've been involved in financial sector assessments in Japan and the United Kingdom. I did a review of market regulation in Hong Kong. I was involved with Jeff Carmichael and others in setting up the integrated financial regulator in Indonesia. I still do speaking around the world on this subject. I do not speak about regulatory issues in Australia for several reasons. The main one being that there would be a lot of confusion as to what hat I might be wearing at the time in view of the diversity of my current roles, which include being chairman of ASX Compliance Pty Limited and chairman of Westpac's insurance companies. So I make the point immediately that I'm speaking today solely as an individual and no other organisation takes any responsibility for what I might say. Now, in the course of preparing these remarks, I came across this historical item. Exhibit A is this original ASC submission to the Wallace inquiry dated September 1996, and yes, I still do have a paper copy. And I intend to do a compare and contrast between the ASC submission to Wallace in September 1996 and the ASIC submission to Murray in 2014 to see to what extent my plagiarism software from the University of Sydney might detect common themes or not. And I'm inspired to do that by that amazing description of David Gallagher's earlier of what he's been doing to all of the other submissions. So I certainly intend to do that. Now, when I was at ASIC, I learnt that there were always 3 points. And if there's any other ASIC veterans in the room, they will remember who it was on the staff of ASIC who said there are always 3 points to make. There are 3 points to make today. The first one is that the basic structure of financial regulation is pretty right. Don't meddle with it. Now, I did wonder whether it was necessary to say that, but I was reassured by reading first in the Weekend Australian and then tracking down, hidden away in the report of the Commission of Audit, the following statement. The functions of ASIC, particularly areas of overlap with APRA and the ACCC, should be considered in the context of the FSI. In the meantime, the registry functions of ASIC should be transferred to the ATO, its consumer protection functions transferred to the ACCC, and its financial literacy functions should cease. I thought, where did that come from? Particularly the last one, its financial literacy functions should cease. So I was delighted when the chairman of the inquiry made the point in his opening remarks this morning about the importance of financial literacy. So where did it come from in the report of the National Commission of Audit? Surely one of the major issues we're confronting as a community is a lack of understanding about risk-reward ratios. And one of the major difficulties that ASIC confronts in the consumer protection space is, in effect, if it wasn't allowed and indeed required to do something about educating the public, the present difficulties it faces in that area would only get worse. Because after all, what you're doing in consumer protection and financial services is explaining to people that if they want to get higher rewards, they are in fact taking higher risks. And that is a really complicated message unless there's some basic level of financial literacy out there. And incidentally, a lot of the financial literacy that ASIC provides is funded by the receipts of enforceable undertakings given by major financial institutions that'll let the side down in this respect anyway. So until I saw this report of the National Commission of Audit, I had not detected that major change to the structure was likely, but more than ever it needs to be said the structure is right. After all, imitation is said to be the sincerest form of flattery, and the adoption of the Australian system of twin regulators by the United Kingdom is just that. I have to admit, though, that back in 1998, when the Wallace report was released, partly because that coincided with the establishment of the UK Financial Services Authority, which started operations in the same year, I thought then that the next step would be to merge ASIC and APRA, and indeed I thought that the timing of that debate would be around about now. So it's worth going back to remind ourselves why it didn't happen in 1997 and 1998. Wallace gave 4 reasons for not merging ASIC and APRA. The first reason was it should be expected and accepted that agencies formed for separate purposes will function best with their own distinct cultures. The third reason was that a single regulator with all of these functions might become excessively powerful. And the fourth reason was that these functions may be too extensive to be combined in one agency with full efficiency. Yes, I left out reason number 2, and Bob Officer will remember what reason number 2 was. Premature. It was said that it would be premature to do it. Now, that's always amused me. You've got these 3 really substantive reasons, 1, 3 and 4. But reason number 2 was that it would be premature. And I've made a lot of money around the years going around trying to track down people who remember what that second reason was. And if somebody can tell me why it's listed at number 2 rather than number 4, I'd be delighted to hear that. In short, I think it is still premature to merge ASIC and APRA, and it may never be appropriate to do it for the very reasons that Wallace gave as reasons 1, 3 and 4. Let me say immediately too that I'm entirely positive about the performance and the capabilities of APRA as well as of ASIC. I speak as one of those it regulates. I don't agree with everything it does though. In particular, I'm not sure that APRA fully understands, and if they do understand it, then we simply don't agree about the distinct roles of boards and management. And others in the room who serve on the boards of APRA-regulated entities will know what I'm talking about. APRA seems to take a view that boards should know everything and do everything about the way their regulated institutions behave. I've already said a little bit about consumer protection. Let me say in particular that I think giving consumer protection in financial services to the ACCC was a bad idea in the mid-1990s, and it would still be a bad idea today. Now, APRA's experience in this area in recent years might be thought to confirm the view that it would be something that they would be better off getting out of. I take entirely the opposite view. I think the whole issue of distinguishing between consumer protection when you're taking deliberate investment decisions as opposed to taking out insurance products, for example, that is a distinction that needs to be well understood. And I think it's much safer to have all of that in one dedicated financial regulator. But that brings me really to the second of the 3 points. And it's really a plea, and it's a plea to the Financial System Inquiry and to the government, and in particular to the Treasury. Please stop giving ASIC more things to do. Now, one of the interesting submissions to the Senate inquiry came from the Governance Institute of Australia, and in their submission, they listed the things ASIC had recently been given responsibility to do, including the Credit Registration and Licensing Scheme with 26,000 new registrations, the Margin Lending Licensing Scheme, the new National Business Name Service, the new Financial Product Authorisation for carbon credits, the Auditor Registration for self-managed super funds, the Tax Agent Registration Service for financial planners, the ABN Business Names Registration Service, the migration of the Register of Company Charges to the new National Personal Property Securities Register. They left out one of the ones which I thought was odd because it might have just as easily gone to APRA, and that was the Trustee Companies Registration Scheme, which transferred from the states to effectively ASIC about 5 years ago. They also didn't talk about the various ways in which ASIC has taken direct responsibility where it used to be the oversight body rather than the doer. And 2 of those affect me personally. One is market supervision, which was taken from the ASX and given directly to ASIC. And the second is, it wasn't really taken, but they've asserted themselves in auditor oversight, despite the attempt by the industry to set up a frontline body which ASIC could merely have supervised. Now, in both those cases, market supervision and auditor oversight, I think the opportunity was missed so for ASIC to be, in effect, the supervisor of this activity rather than the direct doer. But my basic point is that as you give ASIC more and varied things to do, even if ASIC is permanently given sufficient resources for them all, which I doubt ever really happens, you muddy the message that you need to give people about what ASIC is and what it stands for. And this is the culture point that was made by Wallace. And that is the third point to which I wish to turn. So the third point is that ASIC's culture and ethos must be that of an enforcer. Now, ASIC has a very complex message to sell about facilitation and enforcement, but it must only facilitate business to an extent consistent with its enforcement role. And I think, especially these days, it's necessary to keep saying this as well. We cannot expect or require ASIC to win all of the things that it does. A high success rate in its enforcement activity will lead or will be the result of risk aversion on its part. Let me deal specifically, therefore, with insider trading. Insider trading is a crime. It should be prosecuted criminally, not civilly, whenever there is sufficient evidence to support that. Let me instance, first of all, the Vizard case, and then say no more about it. But I need to remind you that he wasn't, in the end, even dealt with civilly for insider trading as such. Let me also talk about the Fish case, that's FYSH. Now, I have read his submissions to the Senate Committee inquiry. In fact, on reflection, they might have been to the FSI, but I've certainly seen the submissions. And if you don't immediately recognise the name, he was the fellow who was charged with insider trading, was tried, convicted, sentenced to jail, served 8 months before the New South Wales Court of Criminal Appeal reversed the conviction. Now, that is terribly difficult and terribly sad. I don't underestimate the personal difficulty which is described in his submissions. But it wasn't just ASIC, it was also the DPP and the trial judge who all concluded that there was sufficient evidence to convict him. Yes, the trial should have happened quicker and perhaps he should have been given bail pending the appeal. But ASIC can't be blamed for all of that, and ASIC cannot be given the message that it must not lose such litigation and that we'd better that it didn't take it than that it lost it. Its only rational response will be only to proceed when defendants plead guilty. Now, the public rightly regard insider trading as a scourge, and it should be dealt with by ASIC in that light, even if the results don't always go its way. And you see, even when they win, they lose. If you think of the John Gay prosecution involving guns, the criticism of ASIC, because the trial judge decided not to send him to jail, but quotes merely, close quotes, to fine him, really indicates the extent of the problem. And similarly, another judge then decides not to ban him from being a company director, and that is apparently ASIC's fault. Can I just say on that subject in conclusion that the academic evidence is that how a financial regulatory system deals with the enforcement of insider trading laws is the single issue around the world which most affects the credibility of securities markets. When I first attempted to type that, it came out as credulity, which I quite liked, but I did mean credibility. Finally, on enforcement, can I say that I wish to discourage ASIC from using penalty notices for breaches of the continuous disclosure rules relating to ASX matters. These penalty notices, which are on a floating scale depending upon the market capitalisation, enable a company to, in effect, pay a penalty for what ASIC alleges is a breach of those rules, but without admitting that they ever got anything wrong. Those rules are simply bad as a matter of policy. And I think the net consequence of allowing people to say, well, we paid it and it's gone away and we don't admit anything and we never did anything wrong anyway, I think that is a bad outcome as a matter of regulatory principle. I hope I've left a few minutes for questions about my 3 points. They are, again, that the basic structure is pretty right, don't meddle with it, stop giving ASIC more things to do, and finally, ASIC's culture and ethos must be that of an enforcer. There's a microphone floating around if you wish to challenge any of my propositions or seek further and better particulars. I'm not sure that a former deputy chair gets the first question, but you carry on, Belinda.
Thank you, Alan. I too backed out for similar reasons in terms of commentary and endorse all your comments. I would just like, I think, to dwell, your comments were taken on the insider trading litigation. I think there is time in terms of speed of actions to look at how these matters are dealt with by the courts, be they civil or criminal. A fully contested case can take 5 years to come from event to outcome, and that's quite common. And I do believe, as some would say, justice delayed is justice denied. That can apply for all. But also, to be an enforcer of actions that take that long to have an outcome is really to have no enforcement outcome. It's not a deterrent. You're in a different stage of the cycle, and that is something that needs to be addressed. I mean, all parties can be more efficient about how things are brought, but I think judges also need to.
Yes, Belinda, I don't disagree. There's another question over there, by the way. There's another question over there. The only thing I would say is that 20-odd years ago when I was first, or more than 20 years ago when I was first arriving at the ASC, then Justice Kim Santo gave me this material about how these major financial trials should be progressed far more quickly and based on research in London. And I don't know that anything has ever really happened in this country to try and deal with that. But the final irony is that that was all directed to far more complex matters in those days. I mean, the issue in the Fish case, for example, and one of his complaints, which I think is valid, is that he spent years in a sort of a limbo along the way. And I have every sympathy for that. The real problem is, what message are we trying to send if we don't deal with matters that do appear on the surface to be that? And I think ASIC will be criticised more and more for not pursuing things, it will be anyway, I think. I wasn't going to go back to this, but I will just say that the most difficult thing I ever did at ASIC was to announce why we weren't doing something. And that was after we had spent years, and some of you will remember what I'm talking about. We had spent years and millions of dollars investigating a particular matter, which was a very notorious, in the sense of widely known matter, and we were finally told by the DPP that there would be no prosecution. That is very difficult for a regulator, and that is a major problem. But that at least was a well-resourced potential defendant. The individual defendants like Dr. Fish are a real problem for the system, and we do have to find ways of doing these things more quickly.
Thanks, Alan. Richard Batten, Minter Ellison. Great presentation. Good to hear your perspective on the role of ASIC over recent years. Just wanted to query on your second point. You say stop giving ASIC more to do. Am I right in reading or hearing from what you're saying that really perhaps we should be removing certain current roles from ASIC? And if so, which ones?
Well, the issue, and it's hinted at in what the National Commission of Audit said, is what you should do with all of the registry functions. I think it's so long ago I can say publicly that more than 15 years ago when I was there, we were debating whether we should spin out the registry in some fashion, because it was culturally and systemically different to the core functions of the Commission. And I read the whole of the list from Tim Shee, partly so you could hear so many of those functions were registry type functions, because ASIC traditionally has done that really well. The temptation to spin that out is very strong. My only nervousness about doing it is that it was apart from being a really good training ground for some of our better administrators, it was core to some of the enforcement activity that you had really ready access to that material. Now that may sound really basic to you, but when we talked to our overseas counterparts, when I was there, we talked to them, they thought that was an issue to them. And I think we're just used to the fact that the corporate regulator is the corporate regulator and actually has that material readily available to it. And so while I think that's the most likely change to occur, But the second thing I would say is that I don't think it's too late for ASIC and the government to think about ASIC returning to an oversight role in some of its activities rather than the frontline regulator. You're going to have to tell me when to stop. Yeah.
Peter Carroll, I'm an actuary. The question, I think, that's of concern is whether in fact you're adding value to the financial system. We're well aware of the costs, not just the direct costs, but the costs that you impose on a whole lot of law-abiding institutions. I would be interested to hear what evidence you have that you've actually improved these things that you're regulating in a commensurate manner, or whether it is in fact just a dead weight cost on the system. That's the problem I have.
But that's quite a complicated question. If you notice the material that David put up earlier show that the cost-benefit analysis of financial regulation is on the agenda of CIFA. So I think we can look to David to answer that question for you more academically than I'm about to do. I noticed that the placard in each place says the Centre for International Finance and Regulation towards financial system integrity. I think what APRA's role is to protect both the stakeholders and the institutions themselves so that they're around for the benefit of the stakeholders, but clearly the role of ASIC is to give the public assurance that the system is conducted with integrity. And it does that by taking enforcement action, fundamentally, in my view. Now, when I mentioned earlier the academic research, which I can send to you if you wish to see it, that shows that it's the enforcement of, not the existence, but the enforcement of insider trading laws that is seen internationally as the chief indicator of the integrity of the system, that is the test. As to financing, of course, APRA is entirely financed by industry levy, which makes the fact that it's also subject to efficiency dividends, in my view, rather bizarre. ASIC, on the other hand, collects all the fees based on a flat tax basis on all of the 1.6 million companies that are out there, and it therefore is a profit maker for the federal government in that sense. So whether you, on the cost-benefit analysis that David's people will be doing will be really interesting to read. I'm not going to assert... So I did leave 14 years ago, by the way. I just thought I should... It worked really well in the 90s. I'll just have to ask Belinda how it's going more recently. Now, there was a question finally over here, I think. Or Peter Kell, who I think I saw somewhere too.
Sorry, Anthony Asher, University of New South Wales. I'm very a fan of John Braithwaite with his views of restorative justice and particularly reintegrative shaming. And just to raise the question of insider trading and the fact you're very adamant that it's a criminal offence. We decriminalised in South Africa. I thought with avoiding many of the problems that you've mentioned, isn't there quite a lot to be said for far more efficient enforcement and decriminalisation of a lot of these things?
I hadn't been aware South Africa had done that, so I admit my relative ignorance on that subject. I'm not saying that every insider trading case should be pursued criminally. There may be some, especially where it is, in a loose sense, you might say inadvertent. I mean, take Mr. Gay. Mr. Gay's trading was not a secret. He consulted all sorts of people before doing it, and then he did it and announced that he'd done it because he was a director and he needed to announce his trades. So I don't think in any sense that his was deliberate insider trading, but where insider trading is concealed, the result of, in effect, clear conspiracy to behave, I think the public expects, and I would expect, that that should be dealt with criminally. And you'd need a lot of persuading to convince me otherwise. I don't think the civil version of it should be taken away. I mean, part of the problem with the Gay case was that he was fined $50,000. The amount he saved by doing that trading was, I think, in the vicinity of $1 million or something like that. And that there was, in the end, no real attempt even to recover those losses that were avoided. That sends a really bad message. And in fairness, the AFP did try and do that eventually, but they gave up on it for some reason that isn't clear to me. I think the public believes that what I will loosely call deliberate or covert insider trading is an offence and really does strike at the heart of confidence in the financial markets. I think I'm being told to stop.
Thank you to Alan for those excellent remarks and questions from the floor. In the interest of time, we probably will have to limit the questions for the next two sessions. Next, we have Tom Karp, who's presently an independent consultant, but a former Executive General Manager of APRA. Tom's an actuary with 15 years' experience working in insurers and almost 20 years' experience as a financial regulator, including considerable international regulatory work. Tom's private sector experience with a large Australian composite insurer, an Australian specialist health insurer. His roles ranged across a variety of areas: investments, accounting, underwriting, policy administration, product development, systems and actuarial. His financial regulatory experience has been with the Insurance and Superannuation Commission in Australia and, of course, with APRA, where he was formerly Executive General Manager. At both agencies, he held executive roles, day-to-day supervision of institutions, major banks, insurers and pension funds, as well as setting regulatory requirements and providing specialist advice. In his last role at APRA, he managed a team of about 140 people. He helped establish APRA when he was the Acting Insurance and Superannuation Commissioner. He also had a role in regulating health insurance funds in Australia. At the international regulatory level, he's involved from 1999 until 2007 the International Association of Insurance Supervisors, as a member of the Executive Committee, Vice Chairman and Chairman of the Technical Committee. Tom's a member of the Professional Standards Committee of the Institute of Actuaries of Australia, who represents them at International Actuarial Association, and is a member of the IAA's Actuarial Standards Committee, which develops international standards of actuarial practice. He's also director of the Australian Reinsurance Pool Corporation, which is a government corporation responsible for offering reinsurance for terrorism risk. So a great range of activity that Tom's involved in. He's been recently involved in project work for the IMF, the FSI in the UK and France. So please join me in welcoming Tom to the podium. Thank you.
Thank you and good morning. It's good to be here. I'll also try and work out the technology. Like Alan, I'm going to emphasise these are all personal comments. I'm involved with very few organisations, so I'm pretty obvious I'm not speaking on behalf of any of them. I'm also going to focus quite logically or obviously on the prudential regulation side of things. I'm going to provide some high-level comments about the inquiry and the GFC first, and then some specific ones about prudential regulation in the Australian context. I also want to add some comments about my international experience, and I think often these things look at what's done somewhere else and say, well, why can't we do it here? So I'll provide some comments about maybe some of the pitfalls of transporting things from overseas. And I'll finish by just touching on a couple of, or a few issues in insurance and super that I think warrant more consideration by the inquiry. Firstly, it's good that we actually have one, and it's good that we actually have these sort of inquiries in Australia when nothing is majorly wrong. It's better to look at them in these contexts than when you're in the middle of a crisis and trying to change things, because that's just not a good time to make some of these decisions. And it's about the right time to have it again, given the timing of the last one. And I agree with David Murray's comments that it's more important to look forward and think about the system we need going forward. It's just very hard to do, that's all. In terms of the GFC, I think it's fair to say Australia passed. Alan also said that, in his view, our regulatory system stood up well and doesn't need change, and I would totally concur with that view in the sense that our Twin Peaks model worked. The UK single peak model clearly didn't work, and they've now realised that. But also the US, what I call the multi-peak model, didn't work either. And so I think you've got to get the balance right, and I think we have got it right in Australia. But that's about regulatory structures and organisations, but there's a lot more to getting the whole system working right. And I think a crucial but less well recognised issue was the role of the Council of Financial Supervisors in Australia during the crisis. This is where, you know, the heads and the senior people in all the regulatory agencies actually work together on issues. Because it doesn't matter how you carve up the regulatory system, there's always going to be boundary type issues. And in my view, that actually worked very well in Australia. I actually retired from APRA as the financial crisis was hitting, and I was involved in some of the discussions around the table between the bank and ASIC and Treasury and the like to try and get a few things in place. But I can tell you from my experience in doing FSAPs in the US after the financial crisis, that's one thing they just did not do at all. They didn't even talk to each other. In fact, half of them didn't even know each other. So actually having, you know, the ability for the regulators to know each other, discuss issues, and then when a crisis evolves, sit down and work through the issues and come up with sensible outcomes and ways to deal with them is actually very important. And you can't put that into structures and rules. I'll make a comment on moral hazard, and it's just a simple one, and that is that we all know that what moral hazard is, and this whole too big to fail issue. In some sense, in a pure conceptual, theoretical sense, we might all like it not to be there. The political reality is it is there. And my view and point is simply that you need a mechanism to deal with the moral hazard issue, and you need to decide what that mechanism is and put it in place before you ever have a crisis. Because when you have a crisis, there will be a political solution to this, and it won't be the right one, because it'll be made in the heat of the moment, and that's not the right time to make these decisions. And the last general comment I'll make is that I think the global financial crisis has demonstrated that market discipline and disclosure approaches do not always work. And that doesn't mean that they don't have value. It simply means they're not a panacea, and they're especially not very good in working against excessive risk-taking at either the corporate or the individual level. So have them in the system somewhere, but don't think they're going to do you a hell of a lot of good in major crisis situations. All regulation is aimed at balancing safety and competition, and the Wallace Inquiry's philosophy was about stronger regulation depending on the intensity of the financial promise and the level of the information asymmetry that exists between the financial service provider and the customer. And that's all still correct in my view. And I think one of the other issues is I think the GFC has rammed home that the cost of financial instability significantly outweighs the cost of effective regulation and supervision. So in general, the broader calls for lower or light touch regulation need to be viewed sceptically. I'm not saying all regulation is good and all set at the right level, but when it's argued from a cost perspective, I think the costs of not doing it are usually much greater than the costs of doing it and doing it half well. In Australia, we have, in a lot of our financial services regulation, principles-based legislation with standards-making power for the regulators. And that's designed to, and I think it has effectively allowed our systems to adapt as the market changes, so you don't have to keep going back to Parliament, etc. One of the points I wanted to bring out here is that in the prudential regulation world, I think one of the things that APRA did get right and is getting still pursuing is this combination of what I call technical standards, which are all standards about limiting balance sheet items or having a certain amount of capital, etc., versus behavioural standards, which are more in the sort of the governance or the risk management space, and so on. You need both of these. I have to say a lot of regulators that I've dealt with in my career overseas tend to focus way too much on the technical standards and think if they can get all that all right, that'll just be okay. But you need to get the balance right, and you need technical standards are more focused on what I would call financial resilience or strength now. Behavioural standards are all about into the future, and you need both of those. And the other point which I think goes with that is that the day-to-day supervision that the regulator actually does is quite crucial. So it's one thing to set rules or standards, but it's another to actually be out there actively supervising the institutions and understanding how they're going about their business. And I have to say, from my experience in doing FSAPs in the US, the UK and France over the last 5 years, which was all post the GFC, that was one of the things that a number of those regulators did not do very well. They didn't actually do a lot of day-to-day supervision. They didn't actually know their companies that well, and they didn't visit them that well, and they didn't pull them up now and again when they felt they were doing risky things. And that has to be part of the mix. It's the soft part of the mix, but it's a very important part of the mix. So getting this sort of mix of technical requirements right, but balanced with the behavioural requirements and then reinforced with the supervision is, I think, extremely important. And if you're going to have a system that actually makes sure that that happens, you actually need to make sure that the regulators have the capacity to do that, which means resources, but also the powers. Often the regulators are not given the resources they need. Alan made the point, sometimes they're loaded up with extra jobs to do and not given really enough extra resources to do it. Sometimes there's not really a proper understanding of the resources needed to do the job. And it isn't numbers of resources, it's often quality of resources in doing these things. Internationally, I think historically Australian regulators and government officials have been quite active internationally, and they should continue to be so. And the reason is that while we in Australia are only 2% of the world on a whole range of measures apart from landmass, we actually are more successful than many of the others around the world, and you'd be surprised, but many of them actually look at what we do and look to us as the good example. And generally in that sort of sphere, we punch above our weight. And my message to the inquiry here is that don't do anything which will stop that happening, because we have contributed internationally quite a bit, and in doing so, we help shape the international requirements by the Basel Committee and others, such that they don't do some silly things which will cause difficulties for us and our markets in Australia. So please don't do anything which will stop that happening. National discretions exist in a lot of the international standards requirements on banking and insurance and securities, and we're going to get them in the pensions area as well. This is a two-edged sword. National discretions in this sort of space means in reality that a lot of these things which are touted as global standards are in fact not global standards, because you can use national discretions to get around a lot of important things. So you need to be a little bit careful when you're looking at some of these international things and how they're applied, and just sort of say, well, that works across the world. Well, there's the international standard, but the way the US apply it and the way Europe apply it and so on might be actually quite different on the ground because of the way they're using national discretions. Clearly, we need to use them when it's important for us to do so, but we need to be, in my view, out there adopting these international standards when they're there, because that helps build our profile and helps our influence internationally in setting all the rules going forward. In my experience, this issue of Australian institutions competing internationally is often an overblown issue that's raised. And in fact, the practice or the practicalities are that competition or competitive success internationally is actually often due far more to how much you know about the real local market and the real local rules and the local cultures, and get that right. It's not due to the fact that your Australian regulator is doing something to you which holds you back. And frankly, if you look at the track record of Australian financial institutions who've actually tried to go overseas in any big way, most of them have actually got it wrong. And had to withdraw and lose a lot of money because they didn't understand the local situation very well and they didn't read it well. And it wasn't about Australian regulations holding them back. So I'm very sceptical about calls for lighter regulation in Australia because it will allow people to compete internationally. When considering regulatory structures and approaches and so on, do not underestimate how individual countries or jurisdictions actually apply their systems, because having one set of rules globally is one thing, but actually making them work on the ground and how they do that is quite different. And it's actually, in my experience, driven significantly by some fundamental cultural philosophies that exist in different parts of the world. And the shorthand I use is that historically the UK has had a freedom with publicity approach to regulation. You can do a lot of things as long as you disclose what you do. I think that's been partly debunked after the financial crisis. Europe, and to some extent now Asia, in my view, has an approach of very much more controlling rules. They want to control a lot of the details, so the regulators have a lot of detailed rules. The US, the shorthand I use to describe that is they have a rules with freedom approach. They don't have anywhere near as many rules as the Europeans or the Asians, but they have a lot of rules. But their view is, once there are rules and you can comply with the rules, then anything else goes. And I know from talking to a lot of US regulators, they're very loath to take on a financial institution if it's complying with the rules, but it's doing a lot of stuff that they think is excessive. Their whole culture and their legal system is such that they're very loath to do anything. So the system that we have in Australia, where the regulators generally set pragmatic type rules, but then back it up with active supervision and take on the institutions now and again when they feel they're being excessive, is, in my view, the right sort of system and balance. But you can't just sort of say it worked over here and therefore we'll transport it here, because the underlying culture and the way it's applied is different. Turning now quickly to insurance, I just want to make a few points which I think the inquiry needs to look at. I do think the role of insurance generally in the economy is still not well understood. The fact that it actually acts as an economic shock absorber is not well understood. And at the individual and corporate, and even in times the economy-wide level, that actually occurs. Many of you may not remember the Cyclone Tracy in Darwin, but there was billions of dollars of overseas capital which came in, which helped rebuild Darwin and so on. So insurance does actually allow those things to happen, and the whole structure of insurers building up reasonable quality assets, a lot of which are actually liquid, does allow all that to occur, and that's a very different financial animal from a bank. And because of that sort of nature of insurance and the way insurers operate, generally they're not sources of systemic risk. And in my view, the only time they can be is where insurers actually have a specific role in a particular part of the economy, providing a particular type of insurance, which usually the banks actually rely on. And if that then fails, then that can cause a problem, a system-wide problem into the bank. So my views on that are that, you know, a lot of these systemic issues are predominantly banking issues. Underinsurance is an issue. I think the financial system inquiry needs to look at it. I don't particularly have any great solutions here. It's worthy of examination is simply my point. Clearly, financial literacy, a moral hazard, but also state taxes are a big issue in all of this, and I just think it needs to more closer examination. And another, what appears to be a smaller product, smaller issue, legacy products in life insurance, superannuation, funds management are an issue. Work had been done to try and move things along and allow a mechanism to more effectively deal with those. A lot of that simply got sidelined when the GFC came along. I think that needs to be picked up again and simply looked at. And frankly, I'd be surprised if you can't find solutions there, as long as the industries involved are prepared to wear some mechanism whereby whatever mechanism allows to change the customer from the current product into some other product, if the industry can accept that customers should not be disadvantaged in that process and so on, then you'll get a solution. And just a few comments on superannuation, which I think is worthy of the inquiry's examination. Generally, the super sector is lightly leveraged, and that's historically, not because they just do it, it's historically it's been part of the regulation. And during the crisis, the sector was essentially, again, acting as a shock absorber to some other parts of the economy. It did help provide some depth and stability in the financial markets, and it was even a source of alternative finance for businesses and Australian firms, and even to the banks themselves. So, you know, actually having this large pot of money there, which doesn't have the same time horizons and so on, and hasn't got the same objectives as the shorter term banking system, does allow a shock absorber type thing. But the point here is understanding the role of the super sector in the full financial economy is important, and understanding how it differs from other parts of the financial sector. With our defined contribution system, all of the emphasis has been on accumulation. And my point here is that there isn't enough thinking about the post-retirement phase. In particular, products, what sort of products do make sense, what sort of products should be allowed, and how can people access what's been built up. And I won't go into it, but I think many of you will know the plethora of tax and regulatory requirements around all of that has built up over the years. All of the individual bits might have made sense, but when you put it all together, it doesn't make a lot of sense. And I think that needs a re-examination. Recognising that with the baby boomers in the next 20 years, we're going to have a big drawdown phase, so there's going to be a lot of pressure to actually do something here. And there's going to be a huge amount of increased medical bills associated with this group. And unless you get proper access and proper products, it's not going to help. And that just sort of plays into the whole longevity risk. And I, when I was in APRA, I was quite frustrated at all of the details there, and it just made it very difficult for anyone to come up with a product which made sense for them and the customer, but didn't run up against some tax rule or some Centrelink rule or something like that. So all of that needs looking at. Superannuation has been pushed as an obvious funder for infrastructure investments, and clearly the long-term nature of super and so on makes all of that sensible, but trustees do have an obligation to invest on behalf of members, so they've got to take that seriously. But there must be a better way of actually packaging up infrastructure investments and pooling them and doing a whole range of things to enable super funds to invest in them and still meet their obligations as trustees and taking proper investment decisions on behalf of members. And the two issues are fundamentally, in my view, about valuing these things and providing some mechanism to get into and out of them, so some liquidity. But it's not beyond the wit of all of us to come up with something which actually works here and therefore allows more super money to flow into infrastructure investments. And the last point I want to make is the now allowable leveraging which is going on inside self-managed super funds is a concern. Because I think it is leading to significant increases in risk, and a lot of it is risk that a lot of people don't realise they're actually exposing themselves to. And you have to wonder, given that there's huge tax concessions involved here, how well is this money actually going to be used to provide retirement incomes for these people if markets significantly turn against them? But secondly, given the level of tax concessions involved, where's the value for the general taxpayer in allowing all this to happen? So I'll finish there on my small grab bag of things that I think the inquiry should look at. Thank you.
The final speaker for this session will be Mike Callaghan. But just before I introduce Mike, just a small procedural thing. We will have a coffee break immediately after this, and there'll be pastries outside, but we are running a little late. So what I'd like to advise you all of is there will be parallel sessions after this. There's a series of them in different rooms. You'll find the instructions about where to go just outside by the entrance. They were scheduled to start 11 a.m, but I think in virtue of the overrun, we'll need to start that about 11:15. So please, if you're organising one of those sessions, please keep an eye on the time for that and make adjustments accordingly. Okay, so with great pleasure, I would like to introduce our final speaker, Mike Callaghan. He's Director of the G20 Study Centre at the Lowy Institute for International Policy. Mike has been a Program Director there since December 2012. Extensive experience in international economic issues at the Australian Treasury and the International Monetary Fund. As an Executive Director International in the Australian Treasury from 2008 to 2012. Also on Australia's G20 Finance Deputy and a member of the Financial Stability Board. Mike has served as the Prime Minister's Special Envoy in the international economy. From 2005 until 2007, Mike was Executive Director at the Revenue Group in the Australian Treasury and was responsible for tax policy and legislation. He spent 4 years prior to that in Washington, DC, as Executive Director representing 14 countries, including Australia and Korea. He's been a member of an eminent persons group tasked with reporting on improving cooperation and collaboration between the IMF and the World Bank. That's quite a challenge there. Between 1999 and 2000, Mike served as Chief of Staff to the Australian Treasurer, the Honourable Peter Costello. Mike had joined the Treasury in 1974 and has held various senior positions in the Economic Division, Financial Institutions Division, Secretary to the Prime Minister's Task Group on International Financial Reform in 1998. He's also worked at the IMF in the early 1980s, has economic and law degrees from the Australian National University, a graduate of the Royal College of Defence Studies, London, In 2009, he was awarded the Public Service Medal for services to the Australian Government, and in 2013 he was made a member of the Order of Australia. So please join with me in welcoming our final speaker, Mike Callaghan.
Thank you very much indeed. My contribution to the proceedings today is to cover some three big picture issues. And the big picture issues I will cover, and the main factor influencing these is the global financial crisis. But the big three issues I'll cover is first, the importance of the inquiry establishing its own regulatory philosophy or its analytical framework, which has to be the foundation for its recommendations. And the more listening to the presentations this morning, the more convinced I am of the importance of having that framework. You'd need it to build coherence around the whole range of issues the inquiry is trying to cover. Now, whether this involves refreshing the philosophy underpinning Wallace or going a bit further, it does have to come down and settle on what its framework or what its philosophy is. To express this another way, I note that many of the submissions start with a general statement that they endorse the current regulatory philosophy. Well, if they endorse it, I think they have to be able to clearly articulate what it is. The second point that I'll focus on is the importance of fully assessing the role and contribution of our regulatory arrangements for the performance of the Australian financial system through the crisis. Many of the submissions, and even the comments we've heard today, start by looking at the resilience of the Australian financial system through the crisis and say this is a testament to our good regulatory arrangements. And I suppose you could sum it up by saying if it ain't broke, you don't need to fix it. But before coming to that conclusion, I do think it's necessary to draw all the lessons that came from the crisis. And my point will be that the resilience of the Australian financial system depended on many, many factors beyond just the robustness of the financial regulatory framework. The third point I'll quickly come on to is one of the consequences of the crisis is the massive drive at the international level through the Financial Stability Board and through the G20 at strengthening financial regulation. And one theme that comes up in many of the submissions is the questioning of the relevance of all these initiatives, which are largely responding to developments in Europe and North America, to the Australian financial system. Now, the response to such questioning is usually to say that we're a capital importer, our financial institutions operate globally, there's little capacity to ignore these global standards. But the official response goes on to say that it's important to work through the international bodies like the G20, like the Financial Stability Board and the other standard-setting bodies to try and ensure that these new standards are right for Australia. But Australia is chairing the G20 in 2014, and as the government keeps saying, this is a unique opportunity to influence the international economic agenda. So the question that has to be asked is, how is Australia going in using this unique opportunity to ensure on an ongoing basis that these global standards are going to be appropriate for Australia? So come back to these three issues. The first point, as I said, is the importance of having a clear philosophy or an analytical framework that will underpin the approach to financial regulation. This has been said before, but I do think it is absolutely fundamental. Now, by way of context to this, I'll just comment on what Olivier Blanchard, who was the IMF chief, or still is the IMF chief economist, and he made these comments in 2012 when commenting on international efforts to strengthen financial regulation in the wake of the crisis. He observed that while there was intense activity in establishing new standards, this was not done against an agreed vision of what the financial system should look like. The desire was to prevent another crisis. As David Murray said this morning, the immediate thing that came up, we will not let this happen again. And there was a generally shared view that banks needed to have better capital, they needed to be less interconnected, and there shouldn't be ever again another call on taxpayers' funds. But there was no agreement on the right role for such things as securitisation, the right scope for derivatives, the role of shadow banking, and there was even uncertainty and disagreement about the effects of increased capital requirements on bank funding costs. There certainly was no discussion of the consequences of essentially seeking to reduce the amount of financial intermediation being done by banks, which is a consequence of increasing capital and introducing leverage ratios on banks. Now, Blanchard concluded that in the efforts to strengthen financial regulation, we, being the global community, we were navigating by sight. We could not rely on over-the-horizon navigational aids because we didn't know what that future financial system is we were aiming for. We had a broad direction, but we didn't know exactly, and by implication, we had no agreement on the appropriate role of financial regulation. So I think in the context of this inquiry, it's going to be very crucial that we don't navigate by sight. The inquiry is going to have some concept of where it wants the financial system to go. David Murray referred to a blueprint for the financial system. Well, it's very important to establish that blueprint and, again, looking for the future. Now, the Wallace inquiry spent a great deal of energy on this issue of establishing a regulatory framework behind its recommendations. And we know the outcome of those recommendations, and it's been discussed today. It was really based around regulatory functions. We had the bodies, we had the regulation of market integrity, disclosure, consumer protection, corporations within ASIC, prudential regulation of deposit-taking institutions, life, general insurance, superannuation and APRA, anti-competitive behaviour, ACCC, monetary policy, system risk with the RBA. But a major challenge that Wallace had, and it exists now and it's even harder now, I think, is where you draw that prudential regulatory perimeter. At the time of Wallace, there was lots of discussions about the question of moral hazard, and it's come up again now, and it's alive and well. When the government starts regulating the activities of an institution, the concern was that there was, by implication, the government stood behind that firm in the minds of the public. Now, this was against the background at the time of Wallace, when there was very widespread general perception that government guaranteed all deposits in banks. Now, as I said, and as people have said today, that this moral hazard is alive and well, and if anything, even more prevalent. I think it's become more prevalent now that we have banks being classified as systemically important. We have our domestic banks here are classified as being domestically systemically important, which does intensify this concept of being too big to fail. Related to the concern over moral hazard, at the time of Wallace, I know in the official family, there was lots of agonising over the position of superannuation. The government was forcing people to put money into superannuation. And as such, the feeling was this was likely to raise some moral hazards. Simply that the government stood behind superannuation funds, but the government's pockets weren't considered deep enough to stand behind the growth, expected growth in superannuation funds. Now, the other issue that I believe exercised the minds a lot at the time around Wallace was the importance of maintaining a risk spectrum when it came to the provision of finance. In achieving this balance between ensuring financial stability while supporting the needs of the economy, there needed to be the capacity to finance risky activities. The outcome from Wallace was to identify those institutions performing certain functions and subject them to prudential regulation, with the rest of the financial system largely left to market integrity and disclosure requirements. In drawing that regulatory barrier, institutions subject to prudential regulation, the Wallace report focused on this concept of the intensity of the promise. And it's not immediately obvious, I think, what this intensity of the promise is. Wallace recommended that the focus of prudential regulation should be in institutions making promises of the highest integrity. A high-intensity promise was one that was inherently difficult for an institution to honour, where the creditworthiness of the institution making a promise would have adverse consequences, particularly for financial stability. It is a hard concept. Now, this approach, it did result, as we said, in banks, insurance companies, superannuation funds being subject to prudential regulation, while the rest, essentially, of the financial system was just disclosure requirements. As such, Wallace did reinforce regulation based on disclosure, a way to minimise moral hazard and to ensure that more risky investment options could be financed, namely disclose the risks and let investors, particularly the sophisticated investors, who are better able to assess those risks, make their own choices. And they would be subject to the consequence of their choice. This was considered preferable than rather attempting to seek to extend protection to cover investors from all risk. Now, how has this approach performed over the past 17 years? Is it a regulatory framework that can be largely endorsed, as many of the submissions have said already? Well, many have said that the problem in the lead up to the crisis was that the risk was not appropriately priced, and there seems to be a general view that the concept of relying on the market to provide discipline and self-correct is misplaced. The concept of the so-called sophisticated investor who can look after him or herself in all circumstances was also considered to be misplaced. Successive ASIC chairmen, I'm not sure if Alan called for it, but I know others have called for a rethinking of disclosure, and even this morning I'm hearing Tom question aspects of disclosure. And in the current ASIC submission, it states the assumption that underpinned much of retail financial services regulation since the Wallace inquiry, that disclosure was the best tool in almost every instance to fix market failure, has not borne out in practice. But the problem I see is if you move away from the disclosure philosophy, what do you replace it with? Do you increase the perimeter of prudential supervision? As we've seen in other countries during the crisis, non-prudentially regulated institutions can also be systemically important. Now, the other aspect of this is that the existing regulatory approach doesn't appear to ensure that the availability of finance is available for all sectors of the economy. As noted in many of the submissions, including from major financial institutions, there are financing gaps. More riskier activities have difficulty in obtaining finance. Small business, startup ventures, and some would say now even the problem of large project financing. All these, are they market failures that require government intervention, or are they problems in the design and application of the regulatory structure? Now, I don't know, but the bottom line I'd come back to is that to be able to answer these questions and ensure you get this balance between financial stability and meeting the needs of the real economy, the financial sector meeting the needs of the real economy, you do have to clarify what is your philosophy for financial regulation and how you're going to apply it. The second point I wanted to cover is the importance of delving into the contribution of regulation to the relative resilience of the Australian financial system during the crisis. It is important to get a good understanding of all the factors contributing to financial stability and to ensure that there's not complacency. As I mentioned, there is a tendency to ascribe the relative resilience of our system to our good regulatory framework. Now, I think that one clear lesson that has come from the crisis, both internationally, is that all the various arms of economic policy are all closely interconnected. As we've seen in other countries, fiscal sustainability depends importantly on the strength and stability of your financial sector. Look at Ireland. Similarly, the ability of a government to support a financial sector under stress will depend on the strength of the government balance sheet. The stability of the financial sector, in turn, will depend on the existence of macroeconomic imbalances, particularly excessive credit growth and also the magnitude of the economic cycle. Alan alluded to this earlier. In short, the stability of the financial system simply does not come down to the quality of financial supervision or financial regulation. It is all interlinked. Now, APRA has clearly moved away from a light touch approach to supervision in the wake of the collapse of HIH. But again, what was the contribution of prudential supervision to minimising any toxic assets in bank balance sheets prior to 2008? I think Ian McFarlane's short submission to the inquiry does have some interesting comments on this. There he notes that one of the factors was that there was plentiful lending opportunities in Australia and there was no need to chase risky investments in business elsewhere. He also says that because Australian banks also partly funded themselves overseas, they were under increased international scrutiny. But that scrutiny didn't appear to be effective in terms of the overseas banks. McFarlane also says that there was a long-standing and deep-seated characteristic of our banking system that predisposed it to stability. Now, I think he's referring to some long-standing conservatism of our bankers. But is this always a positive? Is the trade-off of the long-standing conservatism of our bankers one that we have funding gaps? I don't know. A couple of other important points included the fact that our major banks were not under threat of takeover because of the Four Pillars policy. Now, Bob Officer has commented on this morning, the Four Pillars policy. It was introduced as being supporting competition or to protect competition. And yes, the Wallace report recommended the abolition of the policy. But I think now that more people are looking at the Four Pillars as a contributor to maintaining stability in the system. Our banks didn't have to work their balance sheets aggressively to protect themselves from takeover. Now, this does raise difficult issues confronting this question between promoting competition and ensuring stability. The other important point that contributed to the stability of the Australian financial system was that we avoided a recession because of prompt monetary policy response, and it still had traction because we had positive interest rates, and a rapid fiscal expansion. Macroeconomic stability is a key component, if not the most important component, to the stability of the financial system. And I think this has to be, the whole picture has to be brought together within the financial system inquiry. My third point that I'll come to quickly is this global wave of regulatory change that has occurred since the crisis via the FSB and the G20. As noted in many of the submissions, they have questioned the relevance of this additional regulatory burden on the Australian financial system. Now, if our more intensive approach to prudential supervision was considered to be a major contributor to the resilience of our system during the crisis, then logic would seem to suggest that there's not the same need to strengthen the regulatory requirements here compared with other jurisdictions. Moreover, the more intensive supervision of the Australian supervision, it did bring its costs. It all comes down to a balance between the costs and the benefits you're achieving. Now, the Australian financial system, it did have these extra costs. We could approach this another way and say, in the absence of these international efforts, would we think there was a need to increase the financial regulation to the same extent we have in Australia? Now, one answer I'd come back to this is, and just on that, I'd make a point that there was a big push within the IMF to introduce a charge on systemically important financial institutions on their assets. And the idea was this was to overcome the concern at the time that the governments were standing behind these financial institutions. Within the international agencies here, within the Financial Stability Board and the G20, we led the charge against that, opposing it. The reason we led the charge opposing that was that this was going to increase costs by putting another levy on top of the assets of the banks, where our banks were already under substantial extra costs because we had far more intensive supervision compared to other countries. The idea was it's up to each individual country. If you want to put that extra cost, do you think it's necessary? Okay, but in our situation, we were saying that we had a degree of financial supervision. It did bear a cost on the banks, it bore a cost on the economy. Doubling up on this cost was going to be going too far. Now, as I say, coming back to this question of how much do we need to be implementing what is being done at the international level, there is the response that says we have no option. We had to comply with the global standards. But if this was the case, what is the rationale for adopting even more stringent regulatory approach to the new minimum global standards? And I do think this is what APRA has done. I mentioned previously that while the official response is that we have no option but to adopt the global standards, it does go on to say that it's important for Australia to work through the G20 and the international bodies to ensure that these standards are right for Australia. Now, this is absolutely right, and as Tom mentioned, it is something that has been done in terms of these bodies. But it is a major concern in Asia and other countries. It is a major concern that what we've seen is this international regulatory response is essentially to situations in North America and Europe, and the applicability of this to the rest of the world is a major concern. Australia is chairing the G20, and I think it should be doing everything possible to use this opportunity to establish better processes in the G20 and the FSB to ensure that the positions of all countries are appropriately taken into account in establishing these new global standards, that there is a more effective oversight on the implementation of the standards and an ongoing review of their impact and unintended consequences. To date, Australia has set its priority as G20 chair as to complete core aspects of the design phase in Basel III, ending too big to fail, monitoring shadow banking and regulating OTC derivatives. Now, this is the Financial Stability Board's work plan, and the design phase is one thing, but as we know and as we're seeing, the big challenge is always consistent and effective implementation of these new standards, and that will take place over many, many years and require ongoing review and adjustment. The handling of the implementation of these standards will also have a major implication on the Australian financial system. Now, the government, I feel, is not seizing the opportunity as G20 chair to help establish an ongoing process that will review the impact and implementation of these standards, and also a new wave of regulatory standards that will be coming. My one last point is the inquiry should also consider how to ensure a better ongoing oversight of the appropriateness of the Australian regulatory framework. Is the only option to have an external inquiry every 17 years? The performance of the financial system is critical to the performance of the economy, and I think it would be prudent to think about having a more effective approach to oversight to make sure that we have the balance right. Now, I think this is something that certainly goes beyond the remit of the Australian financial regulators, because they are part of the subject matter that I think does need to be reviewed on a more regular basis in 17 years. Thank you very much.
Thank you, Mike, and please join with me in thanking all of our speakers this morning for an excellent session.